Right, good morning everyone. Right, so this week, so we're just into week 6 now, so just over halfway through. We're going to get a bit more into the real sort of like this session is still going to be more about the processes that you need to go through, but it's going to be a little bit more about the technical side of trading. So we're going to talk about journaling, creating a trade plan, what that looks like. I'm going to go through some templates with you as well, and also what is really important as well is when you're starting out your journey, you don't just think like, right, I've got X amount now and I want to make Y, because you don't have a plan in between. Basically, you need to have that plan in terms of how you're going to get it, because if you're starting off with a modest amount now, then that ultimate goal seems a long way away. But if by creating a roadmap, it helps with the emotional journey as well. So we're going to talk about that. We're going to look at compounding, and I'll stress this now, but obviously I will stress it again later on. It's really important when we look at these compounding spreadsheets. It's there to illustrate the impact compounding can have. It's not to throw big bright lights and loads of money and stuff, but it's really going to show and highlight that really modest gains now can lead to much more significant amounts in a lot shorter space of time than you maybe realize. If you have that roadmap and you know that, then it can really help with the emotional side of things. So quickly going to go into the disclaimer while a few other people join, and then we'll get into the bulk of the session. So like I say, it'll be a few bits of, have a bit of talking, but we're also going to go through some examples and some spreadsheets and stuff as well. So here's the disclaimer. Obviously, I won't read it again. It's just to make you aware that there are risks involved in trading CFDs, and you need to be aware of these risks. So just leave that there for a moment. Okay, cool. So as always, if you have any questions, please fire them into the questions channel or into the chat box. And if it's relevant right away, then I will answer it there and then. If not, I might save it till the end. So please don't think that I'm ignoring you. If I do get to the end and I don't answer your question, it won't be on purpose. I will apologize. So just jog me if I haven't answered your question, and I'll be more than happy to go back to it. So yeah, feel free. No such thing as a silly question. Feel free to ask away, and we'll go through the presentation as we go and answer the questions as we go. Right. Okay, so first of all, it's important to recognize that you do not become successful overnight. You don't just decide today that you want to become a successful trader and tomorrow you're that successful trader. University courses take 3 to 4 years to complete, and even then, when you move into a profession on the ground floor, you have to start on the ground floor and complete further on-the-job training and continue to build your skills. When I decided that I wanted to move into the financial markets, I didn't just go into an institution and start trading their funds. I entered. I went through school. I entered in the back office. I had to get my FCA, or what was then my FSA regulations, and then slowly build my way up. It took me like 4 or 5 years of working from starting my very first job in the financial industry to actually getting into the front office and start trading. So that's not to say it's going to take everyone 4 to 5 years before they're ready to start trading. It's just to really highlight that this isn't something that necessarily happens overnight. We have to put the work in, and we have to develop the skills before we actually start trading, and before we actually can believe that we will be successful at trading as well. You need to prove yourself, and then you need to earn the right to move into the position that you want through dedication, hard work, and promotions. And again, that's the same in trading. You have to prove to you, and in trading, you actually have to prove to yourself, because you're in control here. You have to prove to yourself that you are in the position that you want to before you move into before you promote yourself into the next phase of your trading journey. So we've spoken about sort of that sim demo live thing. You have to prove yourself in certain issues before you actually can then promote yourself into that live trading environment. And even when you're in the live trading environment, you have to prove to yourself that you're in the position whereby you can promote yourself to trading larger capital, etc. New businesses, when they set out, they have that 1 year, 2 year, 5 year plan. and some businesses make a loss in their first year. So we need to be aware of that. And it's not just because we may lose money initially in our journey, it may just be that we need to take a different approach rather than just think, oh, you know what, trading is not for us. It's just making sure we have that right approach, making sure we do the things and have the realistic expectations. And this is the way that you need to think about trading. So you cannot turn £1,000 into fortunes in the space of a year, no matter what the Instagram influencers will tell you. You need to create a plan of where you are and then where you want to get to, and then you need to create the roadmap on how to get there as well. Initially, it's going to be difficult as you don't have, if you don't have accurate data to work with in terms of what returns you can expect. Because you still develop, if you haven't, because you still need to develop your trade plan, you need to complete your initial learning and education phase of the trade before you can really work out that detailed plan. And again, this is all the reason why that first phase of your journey should all be about learning and developing the skills without focusing at all on how much money you can make or what returns you're going to make from trading. It really should be focused on developing your skills as a trader to become the best trader you can be. If you start focusing on the money and the returns, then it's going to lead into all these other issues, and which is why a lot of people fail. So you really need to think of that initial phase of your journey as developing the skills rather than about the money. Once you've got some more data, then you can start creating those plans as to where you are and where you want to get to. When you do reach the stage to go to live trading, compounding your account can have a huge impact on how quickly you can achieve your goals. So we're going to go through what compounding is now, and then we will run through a spreadsheet as well to show you really the impact that it can have. Right. So first of all, does everyone know what compounding is? Or is everyone aware of what compounding is? Okay, so compounding is the process of keeping your profits in your account and then using it to increase your leverage to make higher returns, but at the same percentage risk to your account. It has a huge impact on how quickly you can achieve your ultimate goals. It can also illustrate why most people give up due to the lack of patience or focus on the longer term targets. So for example, if you have an initial investment of just £1,000 and a return of 30% a year, 30% a year is fantastic returns, you will make £300. And most people will think that that is a waste of time for the returns. If you've worked all year and at the end of it, you've only made £300 because you made that 30% returns a year, you're going to think, yeah, you know why is my time invested in that? And obviously, if you've got bills to pay, then you're never going to have an income. You're never going to replace an income with £1,000. But even if you're just like looking to use this as a bit of wealth generation for the future, a supplementary income, just to give you that little bit of extra or something like that, even for the time that you commit with just £1,000, you may sit there and think, well, 300 quid wasn't really worth my while. However, if you had a clear and detailed plan and a focus on the longer term targets, compounding can have a massive impact on your future trading results. So by setting your targets and creating a roadmap of how you will get there, you're going to set a series of minor goals on the way to a much bigger target. And it can help mitigate the impact of that the emotions have on your trading. And you're going to be able to compare your trading journey to where you are on your roadmap, rather than comparing your trading journey to where your longer term target is. Because that may appear quite daunting. It may feel like a long way off. But if you have this roadmap, you'll know how to get there. And there's a really good quote that I like from an MMA fighter called Georges St. Pierre. Because when you climb a mountain, you need to focus on the next 1,000 steps. I think I may have mentioned this one before, but it's like, you know, when you set off and if you just look at the mountain, you look at the peak and you're at the base, you're going to look up and you go, that's miles away. I'm never going to make that. But if you just focus on getting from camp to camp to camp, just 1,000 steps at a time, your first goal is, right, I'm going to get to that first camp. You get to that first camp, right, now I'm going to get to that next camp. Once you get to that next camp, right, now I'm going to get to that next camp. That is going to be you're going to set yourself a series of much more achievable goals. And then that makes that bigger long-term target of reaching the summit much more achievable and much better. So we're now going to have a look at a couple of examples of compounding. Again, I just want to reillustrate that, reconfirm that this isn't to sort of like sit there and say, you know, you could be making this much money, you could like look how much, like look how big your pots can get. It's really just a way to illustrate how much of an impact compounding can have. So in this example, we're going to start with a trading account of £1,000, which means we risk 10%, £10 per trade, which is 1% of our account. Like you could risk £20 per trade, but we're going to, in this example, we're going to risk £10 per trade. We're going to assume that we make 25% returns in a year, which is still a very good return. So in 2023, we make £250, and we now have a bankroll of £1,250. So therefore, people have made £250. They think, oh, £250 for a year. Oh, what's the point in this trading stuff? Like, I'm just never gonna. I'm like making £250 a year is just not what I want to do from trading. But the following year, we're going to risk £1,250 per trade, which is still only 1% of our account. Now, it's only a small increase, and again, the next year you only make £312.50. Still a relatively small amount. And again, after 2 years, you're sitting there thinking, like, you know what, I've made £562 in 2 years of work. It really, this really isn't worth my time. But if you're using trading for a wealth generation type of thing, type of vehicle, if you stay patient, by the time you come to sort of like 15, 20 years later, you focus on that long term, you can actually stick to sensible leveraging. And by year 20, you have a trading account of nearly £70,000, risking nearly £700 per trade, and you make £17,500 per year, all from just an initial investment of £1,000 and sticking to that long-term strategy, sticking with the process, sticking with that patience. Now, again, this is starting off a very, very small amount of capital, not adding to it, but just sticking to that process. You can see that from that initial investment of just £1,000, compounding means that 20 years later, you've got a really decent amount. So if you're using it for that wealth generation, maybe some sort of pension or something like that, then it's it can actually, even starting with very small, modest gains now, can actually turn into something a lot more significant. Let's use the same example, but let's imagine we can save an extra £20 a month, so just £20 a month to add to your account, or let's just call it £250 a year just for rounding purposes. You still start with an initial trading account of £1,000, risking £10 per trade, but in 2024, you can now risk £15 per trade, which is still only at 1% of your trading capital, keeping leverage sensible. Now, obviously, again, that year you're only going to make £375. You're still making very small amounts, like you're in the original example. So you've only made £875 over those first 2 years. But if you carry on this way and you continue to save £20 a month, and you continue to follow the process, in the same scenario, by year 20, you now have £140,000 in your trading account, risking £1,400 per trade, which is still only 1% of your trading account, and are now returning £35,000 a year, all from just an initial investment of £1,000 and adding £20 a month, which all of a sudden seems much more affordable, much more achievable, but you're obviously going to have the patience and the long-term view to make that work for you. So obviously also imagine if you have a little bit more capital or to start with, or if you can save a little bit more money each month, what that can do over that course of time. So I do have this spreadsheet here. I was going to run through some things. So say you had £10,000. So you did have £10,000, and you could save £50 a month. So you're topping up £600 a year. All of a sudden, you know, that £10,000 and £50 a month turns into £1 million in 20 years' time. So if you're thinking of this as a longer term wealth generation type of vehicle, it can have a massive impact on your trading, on the returns over a sustained period of time. So even though it may seem very modest at first, if you stick with that process, it can turn into something much bigger. Now, obviously, this is for people. This is not for somebody who is looking to create a full-time income from it. You haven't got a startup capital or the potential to be able to generate enough income from trading. That said, if you could, I do have a monthly spreadsheet as well, whereby this is something that I use. So you have a starting balance, you have what your average monthly returns may be, what you can top up on a monthly basis, what you need to withdraw to pay your bills, etc. And then you can work out how long it's going to take you to get to where you need to be able to withdraw funds from your trading account. So say you start with £10,000, you sit there and think, right, okay, I need to make £5,000 a month to be able to quit my job and make trading a full-time income. You know that your trading plan has a monthly return of about 5%. You can sit there and go, right, okay, I start with £10,000. I can top up by £50 a month. How long is it going to take me to get to that? I need £100,000 to be able to earn £5,000 a month. How long is it going to take me? Well, I start in January 2023. It's going to take me nearly 3 years to get there. It's going to take me, just over 3 years to get there, nearly 4 years to get to that point. Can I invest more capital? Can I top up by £200 a month? All of a sudden, that roadmap looks a lot different. That roadmap now means that within just over 2.5 years, you're 3.5 years, you're there. So just being aware of this, it can set you where you are on your roadmap to work out how long it's going to take you to get to where you want to be. It can have a massive impact on the emotional side of things as well. So hopefully that sort of illustrates how important being aware of all these sorts of things are. Right, before we move, well, actually, one more slide on compounding. So obviously, these are all hypothetical scenarios. You cannot guarantee the same returns each year. It's not a case of, right, okay, we are going to make 25% a year. We are going to make 5% a month. You need to work out what your average is and then put that in. And obviously, that's going to fluctuate, but it's just going to give you that guideline. You also may need to draw down on some of those funds from time to time, or you may go through periods where you cannot continue to add in to top up your account like you were. Maybe you're overcommitted, maybe the cost of living crisis, etc. Maybe means that you can't add as many funds as you expected to. But it also allows you, if you have that spreadsheet, it allows you to adjust this and see how your roadmap changes. But hopefully, obviously, as I've said, all of this illustrates what can be achieved with a focus on the larger goal rather than a mindset of instant gratification that society teaches us to have these days. You also have to be aware that everyone's goals, plans, expectancy rates, and ultimately returns will also be different, and you're going to need to personalize these to find out your own goals and targets. You can't take my monthly return targets, my annual return targets, and pump them into your goal, your plan, your goal calculator, because unfortunately my plan and my expectancy rates are going to be different to yours. So you need to work out what yours are to be able to work out what it is. Maybe when you're starting out, you can work out, right, okay, I've got this and I want to achieve where I want to get to by a certain time. You can then work backwards and work out what monthly returns you need to achieve or what annual returns you need to achieve to be able to reach your ultimate goals. That can then will have you give you something to work towards, and it will also tell you whether you're being unrealistic or not. You know, if it says you need to make 50% returns a month to achieve your goals, I'm sorry, but that is going to be very, very unlikely to be achievable. So it's just trying to then you can sort of sit there and reassess and reevaluate what your time frames are. So as I say, hopefully this illustrates that setting the goals and understanding where you are on your own journey, the rewards will come in time. So any questions on that, guys? And obviously I've used the example of like monthly returns, yearly returns there and stuff. This can be adjusted to sort of like to day trading as well, to sort of like generate an income. It's not just that wealth generation, looking for the longer term in terms of yearly projections. You can do this on a monthly and weekly basis as well. Any questions, guys, before we move on to the next sort of topic, which is going to be trade journals and trade plans? Okay, cool. Right, well, any questions you have, please just give us a shout and we can come back to them as well. Right, so trade journals and trade plans are two essential documents that you will need and you will need to keep up to date to succeed in trading. I do not personally know a single successful trader that doesn't have these documents, that does not keep a regular trade journal and does not have a detailed trade plan that they stick to. Some people, I would sit there and say after like 15, 20 years or so, may have their trade plan so built into the subconscious they don't have it written down. Personally, I've been trading 20 years. I still have a written trade plan. I still keep it on my desk. I still have my rules and everything like that, as a reminder to my principles and everything like that. So going back to treating trading as a business, every business when they start up has a business plan, and as traders, our business plan is our trading plan. And as the saying goes, failing to prepare is preparing to fail. So these documents have the ability to keep us safe, but they also have the ability to help us analyze and improve our performance, which is really important. Just because we have a trading edge doesn't mean to say that we shouldn't keep looking to improve. It doesn't mean to say that we don't keep looking to better our trading plans, create a better edge. And also, you know, if our performance drops off, these documents allow us to analyze our performance and see where our performance is dropping and the areas that we need to work on and focus on to improve to get back to our peak performance. They give us structure and they give us a framework to work towards when we enter the markets. So even if we are profitable as traders, they allow us to analyze our trading so we continue to improve. So as I say, they give us the structure and framework to work towards, and when we enter the market, it's really important to create this structure to take as many of those cognitive, sort of those thinking processes away, so that when we go into the markets, we are just acting towards our plan. There's no ambiguity. We're not giving our mind the freedom to make its decisions based on the way that it feels emotionally at that time. We're sitting there saying, this is the structure. When we enter the markets, this is what we do. And that, therefore, it takes that it takes the edge away from the emotions, hijacking our trading decisions. So first of all, we're going to look at our trade plan. And then I've got an example of a trade plan template as well, which I will go through, and the sorts of things that you want to include in your trade plan. Again, just a quick sort of show of hands or a quick yes or no. Does everyone have a detailed trade plan? Does everyone have a trade plan they have written down on their desk? Or do they have one written down? Or have they had one in the past? Have you had one in the past? Okay, cool. So hopefully this will give you an idea of the sorts of things that you start need to think about that you want to get into your trade plan. This isn't like a 10-page document. My trade plan is literally a 1-page document. Okay, so it's not some real detailed, in-depth thing that you need to have, but it is a document that you have it there. It keeps you safe. It has you something to reference to, and in time it builds up into your subconscious. So you just know it straight away. So the trade plan is a document that provides rules and structure to our trading. Amongst other things, it should define your trading principles and rules, i.e. the sessions that you're going to trade, the strategies that you are going to trade. Excuse me, most importantly, it will define the risk that you're going to trade with each strategy. And it will also set out your short, medium, and long-term goals. So as I say, you should have a copy of it, certainly initially printed out and kept on your desk. We can update this. I update my trade plan. I mean, I used to do it every month as I was developing it. Obviously now I have a pretty established trade plan. I review it once a month, but you know, very rarely do I actually have to update it now. But I have it defined, and I review it once a month. And as I say, you should review it regularly. Personally, as a day trader, review it once a month. You don't want to be changing your trade plan loads of times and all the time, because again, if you keep changing your trade plan, this is going to create confusion, and you're not sticking to something. You're not giving it the time to develop and show. You're not giving yourself the time to develop the skills to execute your trade plan. So it's really important that we review it regularly, but we're not just chopping and changing it all the time. We want to get this sort of like really established consistency in our trade plan. As always, our aim is to have a plan with a positive expectancy, and if we have this, then quite simply, all we have to do is follow the plan. There's a couple of blogs actually on my website. I'll post them in the chat room now. If you bear with me 1 second. There's that one, which is create a roadmap to success, and there's this other one which I wrote, which is you have 2 jobs as a trader, and it sounds really simple. And okay, so you should have both of those in the chat box now. So 2 jobs as a trader. So your 2 jobs as a trader is to create a plan with an edge. Your second job as a trader is to follow that plan. And it sounds very simple, and ultimately once you've created that plan, trading does become that simple. But to get there, it is a lot more complicated, as I'm sure all you guys are aware. But ultimately, once you have that plan with the trade, with a positive expectancy, if you have that plan in place, all you have to do is follow that plan and execute that plan, and ultimately it should be fine. You should make money trading. So this is a template I've got for your trading plans. You should start out with your trading rules and principles. It should stipulate the time that you're going to be at your desk to enable you to prepare properly to trade the financial markets. It should determine when you will and won't trade. So it should, for example, sit there and say, like, you know, if you're unwell, you wouldn't go to work. You're not going to be mentally or cognitively focused enough to work. So why would you think you are prepared to actually go into the financial markets and trade? You're going to be, if you're not in a right mental state, like or physical state, you shouldn't be trading. And then also any other routines you need to follow. So i.e., do you need to read your trade plan every single morning? Do you want to do exercising? Personally, I do my mindfulness practice before I start trading as well. I need to complete my mindfulness practice because I need to make sure that I'm in the right mindful state to be able to be focused on the markets when I go in. So I have these sorts of things detailed in my trade plan. I then have risk management strategies. So you want to stipulate if you have any risk parameters, so how much you're going to risk per trade, if you have any loss limits. So do you have a maximum amount that you're going to be prepared to lose on a day, a week, a month before you stop trading and analyze your performance? So personally, I have a maximum 1% risk per trade. I have a maximum 2% risk per day before I stop and I analyze, and I check in to make sure that I'm not doing anything wrong. A maximum 5% loss per week and a maximum of 10% loss per month. Now, I don't think I've ever hit my 10%. I can't remember ever hitting my 10% per month rule. I have hit my 2% daily targets. Obviously, my 1% risk is defined, and I have hit my weekly loss limits once or twice. But they're there. They should be realistic targets there to protect your account. And you don't necessarily have to stop trading for the rest of the week like some people do. You may put that in there. But you certainly do need to stop and just check in with yourself and check that it's not your performance. If you're making mistakes and you're not in the right state of mind to make the best performance, then you should stop trading until you're in a better place. Other things, you should define your strategy. You want to define the risk on percentage of your account per trade. So, you know, although I sit there and say I risk a maximum of 1%, some trades I may only risk 0.5%. So it's different from, if it's different from my risk management strategies, then maybe I need to stipulate that. Outline some details around the rules of strategy, how your entry criteria, maybe where your stop is going to be, that sort of thing. The time frames that you're going to take that strategy on, and also important, the markets you're going to trade, the markets that you're going to trade it on. If you're going to trade it on the FTSE and the DAX, for example, you stipulate you're going to trade it on the FTSE and the DAX. You don't trade it on the euro dollar. You don't trade it on the S&P. You don't trade it on oil. You define the markets that you're going to define that strategy on. If you go away and you test and you realize that, you know, that strategy works on other markets, then you can bring those markets into your trade plan. But you don't just trade, like you all the time that you have those markets stipulated that they work on your trade plan, you should not be trading outside markets. Also then put any other relevant principles and risk management techniques that are going to help with your trading. Put a brief description of your trader and personality profile. So for example, on this one, I sit there and say, right, like, you know, I don't like holding trades over sessions because, you know, I like to sit there with a clear mind when I sit at my desk and start my mindfulness practice, those sorts of things. So ideally, doesn't have to, I don't have this as a strict thing, but ideally I'd like to be out of a trade or risk-free when I leave my session, and I do not hold trades over the weekend. That is part of my, is one of my principles, is I do not hold trades over the weekend. Again, this doesn't have to be your principles, but they're the sorts of things that you should be putting into your trade plan. Also, really important, detail when you're going to complete your trade journal and how often you're going to review it. And also detail how much time you're going to put into your education to improve your trading. Maybe put, right, I'm going to spend 1 hour a week in trading simulators to improve my pattern recognition skills. I'm going to complete my journal at the end of each day, and I'm going to analyze it once a month. Those sorts of things should be in your trading plan. And then finally, set out your short, medium, and long-term targets. So it may be at first, my short-term targets are to become profitable. My medium-term targets are to return 5% a month. And my longer-term targets are to have a £100,000 account to return £5,000 a month and replace my income. That sort of thing. Not really detailed, but just like an outline of what your goals are. If you know it, what your expectancy of your trade plan is, and then also if you're going to have, if you do have your plan to your trading as a replacement income, how you're going to generate income, how you're going to pay yourself on a monthly basis. That's not going to be relevant to everyone. You may sit there and say, right, I'm going to sit there and compound my account and I'm going to look at this in 10 years time. Again, you may have that as one of your targets. I'm going to compound my account for 10 years to develop the best returns I possibly can, or something like that. Okay, guys, so moving on, is there any other questions around our trading plan? Is that clear in terms of the types of things that we should have in our trading plans? And also, just to confirm, you all got those links to the blogs on my website. Perfect. Okay, cool. As I say, feel free to ask any questions. We can come back to these as well. So going back to the presentation, we're now going to finally look at a trade journal. Again, just quick yes or no. You only got one. Hang on, let me put them in the chat box then, see if that helps at all. There you go. Hopefully you should have both links there now. Right, so again, just quick show of hands, quick yes or no. Does anyone at the moment complete a trade journal? Do you have a trade journal? You have done in the past. Okay, cool. Again, this is something that I keep up to date. I review it regularly. I make sure it's completed. I personally try and complete it as soon as I finish a trade because it's fresh in my mind. Others may want to do it at the end of each day. If you're a bit of a longer term trader, maybe you'd do it like once a week or something like that. But you really want to keep it up to date and analyze it regularly as well. I'm just trying to find sorry, I had all these open, and then obviously when I had the power cut, it took them all away. So right, so our trade journal is a document that details all of the trades that we take and how we manage them. There are some platforms out there that offer journaling software. You might have heard of things like Edgewonk, so you can do them like web-based. However, I often feel that these overcomplicate the process and I personally use a basic Excel spreadsheet. Some of these other journaling softwares and stuff, they have like tons and tons and tons of data, which just like can be a little bit overwhelming to work through. I have personally found working with other clients that this journal that I generally use, it's a basic Excel journal, is enough for me to analyze my client's performance and work out some of the things that maybe that need working with. Like, for example, I once had a client in Australia, and we worked out that as the day got on, he was lived in a really hot part of Australia, and as the day got on, he just sort of like got a bit hot and bothered basically, and he lost his focus. So all it meant was he had to stop trading in the afternoons, and he became a profitable trader. It's like you can really work out some very simple things like this. Or another guy, we worked out that he felt lethargic after lunchtime, and it was a case of, right, okay, you need to change your diet at lunch, or again, you don't trade in the afternoon after you've had your lunch, because he was having these really heavy lunches, which again just made him like cognitively like a little bit sort of like brain fog and stuff. So it is quite funny how you can find some very, very sort of like specific things from some quite generic data. So as I say, I'm going to show you an example of the spreadsheet that I use, and I'm going to sort of sit there and show you why I look at these sort of metrics as well, and the data that you want to be looking at. But ultimately, it should be make part of your routine. So it should be in that trade plan to complete your journal as soon as possible, ideally as soon as you exit a trade, so that the details are fresh in your mind and it is accurate as possible. As I say, you would at least want to do this every day if you're trading each day, or looking at the markets each day. If you're only sort of like trading on the higher time frames, you may want to do it once a week or something like that, because you won't necessarily be trading each day. It allows us to analyze our trading and look at the variables that we can change to improve, and it allows us to spot patterns in our trading that may be working or not working for us. So if we find something that really works for us, obviously maybe we can focus on that and maybe look to increase leverage, maybe look to expand that strategy further. Or also, so it's not just about looking for those weaknesses. Obviously, we're looking for those weaknesses as well, so we know where we need to focus our cognitive resources to educate ourselves or to build the skills. 100%, that is what we're looking for. Is we're looking for those weaknesses as to, maybe it's a case of, okay, that's not working for us, we need to take that out of our plan. Maybe that's not working for us, what can we do to focus to improve that? But it's also worth looking at, right, this is working really well for us. Can we increase our leverage slightly to maximize our returns on that? Do we need to focus, like, we're trading really well on euro dollar, let's focus on that and see if we can get an extra couple of trades out of that, rather than spreading it across euro dollar, the DAX and GBP US dollar. But so it's really just working out these sorts of things to what is working for us, what is not, so we can improve our performance overall. Okay, so this is the template. As I say, it's a very basic template. You have your account balance at the top of at the top, and therefore, if you make, say you make £100, it's going to tell you made 1%, exactly, for example. But these are the metrics that we look at. I look at the day of the week that we trade. Again, the reason that I do this, I have worked out with clients that they don't trade well on a Friday. Some people, they don't even trade well on a Monday, because they're sort of like back into it, and like, then although I personally perform better at the beginning of the week because I'm fresh and I'm keen, some people, especially when they start out on a Monday, they're almost too keen to get back into the market. So because they're too keen, they force trades or something like that, and they start getting into the market before without sticking to their plan. So day of the week can be important. Sometimes I've heard some, I haven't necessarily found this, but I have heard some traders talk about their strategies work better on different days or different times and stuff like that. So it's really, that's another reason you can analyze your data to see whether there's better days to trade your strategy or better days that your performance is better. I look at the date, I look at the time again. And very similar sort of thing. I spoke about those couple of examples of where we found out that in the afternoons people's performance dropped off. Maybe again a strategy works better when there's higher volatility. So around those market open times on the index markets, around the market close times, maybe over the lunchtime sessions when volatility drops off and you can get this really sort of like compressing, contracting type action, your strategy doesn't work so well. So you can stop trading that strategy over certain periods of time. You only trade it in the first couple of hours, you only trade it in the last couple of hours of the trading day, that sort of thing. You can really work out, you know, sometimes on the FX markets, you get a bit of a fake out move early on in the London session. So maybe it's better to wait for the FX markets to settle down before you actually get involved. Maybe you don't trade the FX markets before 8:30, that sort of thing. Like that can really really have an impact on determining when to trade your strategy. Instrument, again, maybe some strategies work better on some instruments, and then you can focus your time on those instruments. Maybe your trading personality is better suited to certain instruments. For example, you may be better off suited to something like the DAX, which moves a lot quicker. It's a lot less forgiving, but you know where you stand with the DAX much quicker. It's much more decisive than something like the FTSE, whereby it's a little bit more slower. It's a little bit like, you know, you maybe have to sit through trades a little bit longer, that sort of thing. So maybe you can start working out that you just have a better performance on different markets and different instruments. Strategy, obvious reasons. You want to work out which strategies are working for you, which ones aren't. Time frame, again, work out some people will work better on some time frames. The minute may be too quick for them, or maybe like those lower time frames of 1 minute, 3 minute, 5 minutes, just too quick for them. They don't like this. I've got to think quickly and act very quickly. It may be that those higher time frames are better for them because I have a bit more time to think. I have a client who is trading alongside a full-time job, so we've worked out that, you know, he doesn't trade those lower time frames well because he just doesn't have the time to sit there in front of the screens all the time and make those trading decisions. So, you know, it's better for him to focus on those 4-hour time frames and above, where he can dedicate time every 4 hours or outside of his work to be able to really focus on and make efficient trading decisions. You want to detail how much risk you put on each individual trade, so you can actually work out if you're over risking. If your risk is, make sure you're risking consistently, especially towards each strategy. That's what that is really important, because it will flag up any discrepancies between your consistency and risk, or if you're over leveraging. If you start having loads of trades where you're risking 3, 4, 5%, then that's an area that you need to focus on. Whether you want to buy or sell, again, I had a client, we worked out that he just had this bias to be long in the stock markets. He just always felt that the stock markets went up, so he never performed well when he sold the market because he didn't feel comfortable selling the market. So he had to focus on the buy side. All of this is just coming from analyzing trade journals and then learning more about why these sorts of things happen. The open price, stop price, target price, just so you have those trade details, the number of points that you're targeting and the number of points that your stop is. Again, this is really to determine your risk to reward and make sure your risk to reward is in line. Obviously, you're going to have the win and loss, whether you have a win or a loss, because that will allow you to work out your expectancy rate. And then by knowing your risk to reward and your expectancy rate in terms of your win versus losers, you're going to be able to work out your expectancy rate overall and whether you've got positive expectancy. Now, one thing that I also recommend my clients to do is have a section where you have, so if it's a win, you just put a 1 in the column. If it was a loss, you put a 1 in the column. So if you win, it's a win 1, loss 0, and you made £150 or $150, you now make 1.5%. If you lost, you lose $100 and you're minus 1%. So and then down here it calculates your overall results. What I also advise my clients to do is you have your traded amount and then you have your set and forget. So your set and forget is literally if you put the trade on. So say for example you scaled out of this one and you only made $125, but if you'd set and forget you would have made $150. Well, now what you can start to see is actually by managing the trades, I'm actually making less money than if I set and forget it. So how much difference, how much variance would I have on my account if I just set and forget it, am I making more money? Therefore, maybe that's the style of trading I need to switch to. Again, this is something you can tell just by journaling your trades. Just a quick yes or no, did you follow your trade as per your plan? If you did, brilliant. Say you came out early and you're like, no, I didn't actually follow my trade plan, but yeah, I did on that one. Again, this will tell you very quickly if you're following your trade plan. You want to be following your trade plan 90% plus of the time, okay? You've got to allow yourself for like imperfections as human beings. You're going to make mistakes. You're going to make some decisions which actually are out of your trade plan. You want to be making sure that you're following your trade plan 90% of the time. If you're not following your trade plan 95% plus of the time, then you know you need to work on your discipline to follow your trade plan. You know you need to work on understanding your trade plan better and building it into your subconscious so it becomes a natural reaction to your decision making. You know that's where your focus is, because if you have a trade plan that has a positive expectancy and you're not making money and you're not following your trade plan, you can't blame your trade plan, because it's you that needs to take responsibility for not following your trade plan, which as a consequence means you're losing money in the markets. So you need to, if you identify that your trade plan has that edge and you are following your trade plan 90 to 95% of the time and you're still not making money, then you know there's an issue with your trade plan and that's what needs to be changed. But if you're not following your trade plan, you know you need to work on you. It's not the strategies in your trade plan. It's not the trade plan as such. So, and again, this will come down to, you know, say you've over risked on a trade, you've risked 2%, and that's not part of your trade plan. You will be able to identify, you say, right, okay, I didn't follow my trade plan. You can then filter out all the ones that you say, right, I didn't follow my trade plan on. Oh, well, look, they're all the ones that I'm over risking on. So I know I need to work on following my trade plan in terms of the risk that I'm putting on per trade. So these are all the sorts of things that we can get just by analyzing our trade plan. Again, one other thing, we have some trade notes, so some details of the trade, maybe, you know, scaled out too early, that sort of thing. Emotions, felt anxious within the trade, those sorts of things. Just very slight things, and what you'll be able to do then is work out if there are any patterns. Do you keep scaling out too early from your trade plan? Do you always feel anxious in your trades? Because if you're always feeling anxious in your trades, then you know those emotions are going to be hijacking your decision making, and we know we need to work on our emotional side of things and our mindset to then start following our trade plan. And if we then start following our trade plan that we know has a positive expectancy, then we're going to start making money. So really, this is like essential. It's our #1 tool to analyze our trading and make sure that we know the areas and I can identify the areas that we need to work on. Without this, you will honestly, it can be so enlightening in terms of you be like, oh yeah, I didn't think about that, but actually that makes sense. Like I say, those clients that I told you about, first of all, the guy who we worked out was just really hot and fatigued in the afternoon. He would never have known that if we didn't spot those patterns in his trade plan. Like again, the guy that was losing money when he sold the market rather than buying the market, we would not have known that. He didn't realize that he had this long bias in the market until we identified that he felt more anxious and uncomfortable when shorting the market, and he lost more money when shorting the market than he did when he bought the market, because he's got this belief that the stock markets generally go up over time, which they do. That doesn't mean to say that we always should be long on the market, but he had this internal belief that was the case. So without the journal, he would not have been able to identify that, and he would not have been able to improve his trading. Okay, guys, so that I think is probably about 50 minutes, 45, 50 minutes worth of, I've got, I know we're at 11 o'clock, which is the time this normally ends, but I lost sort of 5 to 10 minutes trying to get everything sort of set during that power cut. So 5 to 10 minutes of any questions. Have you all found this useful? Can you see why these documents are so important? Why having a plan is so important? Okay, good. Any questions about the things that need to be involved in a trade plan? Any questions as to why I don't include certain things into journaling? I don't know if there's something, a parameter you specifically look at or been told to look at and I don't look at it. Is there any questions around that sort of thing? Yep, I made my own Excel template. Yeah, it's my own one. I made my own goals calculator. I made my own Excel trade journal. I mean, the trade plan is just a Word document, but again, it's just a very easy to read all myself. They're very basic and easy to do. If you've got, I don't have any complex Excel skills whatsoever. I've never done any Excel courses or anything like that. How detailed should a strategy be documented? So an example of one. So okay, I'll give you an example of one of mine. So I've got my trading plan here in a desk. So I look for won't mean too much to you. I look for opening spikes on the FTSE and DAX as an example. And what I'm looking for is a liquidity grab early on in the session from the overnight range. Now I'm going to talk about liquidity grabs later on. I think it's in 2 or 3 weeks time. So don't worry about the terminology or anything like that. My opening spike strategy on my trading plan says I will identify the areas for liquidity grabs pre-market. So when I go through my trade plan, I know pre-market I need to identify the areas that I'm looking for. I will wait for price to trade below the identified level and place an order just back inside that level. So I now know that when something happens, I have to place an order at a predetermined price that I know pre-market. On the FTSE, it will be calculated on a 10-point stop and DAX on a 20-point stop. So I now also know where my entry is, and I know what my risk is calculated on, and I know the areas that I'm going from. As soon as it's triggered in, I will move my stop to a break of the swing high low that's created. So again, I have another action that once I'm triggered into the trade, I know I need to tighten my stop to a certain point. It will be traded with a risk of 0.5%, and it can be traded on the FTSE and DAX only. That is it. So just a couple of sentences detailing what I'm doing and how to do it, how to calculate the risk, what the risk is, and what markets it's being traded on. Is that clear? Is that all good? Perfect. Thanks, Gary. Yeah. Good stuff. So yeah, it doesn't have to be some sort of like really in-depth, like loads of paragraphs, just some very short bullet points. They're all down in bullet points. It's not like big long sentences or anything like that. It's just like very short bullet points so that I can go, right, okay. It's basically like bullet points, like they're basically call to actions, okay? So that again, once I've built this in, I automatically now identify the area pre-market, I get my ticket ready, I know the area that it moves to. As soon as it's there, I can calculate my risk pre-market and everything, and I know all I need to do then when I'm trading, when I actually get into trading the market, is when price goes to that point, I click the buy or sell button, and then I know to place the order, and I know that when that triggers in, I need to tighten my stop and I need to put my target in, and then that's it. That's my trade done. Then it's just down to the trade. My only actions are done and they're detailed within my trade plan. So after that, I'm just like, right, okay, now it will be what it will be. So again, just by having that structure and that trade plan, it takes away all this second guessing, meddling of the trades, etc. All I need to know is I have confidence that that has a positive expectancy, and I just need to follow that. It's quite robotic, can be quite boring, but it's profitable. Okay, guys, so if we haven't got any other questions, we'll wrap it up there. We do have a session next week. We're going to touch on some of these emotions that we talk about. We're going to touch on them, hopefully offer a couple of techniques as well to take away and help you with it. But emotions are something that we all experience in trading. Anyone who tells you you need to remove emotions from your trading doesn't understand emotions. You don't need to remove emotions from your trading. You need to learn how to live with them and stop them from hijacking your decision making. That is what you need to do. Emotions can be very useful, and they are a natural part of us. So it's not eradicating them. It's not thinking. It's not placing blame on them. It is just a case of being able to identify them, work with them to make sure they don't hijack your decision making. Very different sort of approach. So we'll touch on that next week. And yeah, then we're going to really start getting into the technical side of things and actually start looking at some charts and price action and strategies and stuff like that. Right, so have a great week, everyone. Apologies, sincere apologies about the technical mix-up earlier on. Apologies for the power cut, but hopefully once we got into that session, you managed to take some really useful tips and stuff from it. Have a great week, and I'll see you all again next week. Cheers, everyone.